Welcome to Cashflow Positive, where we demystify the world of finance and investing for you. We're your one-stop destination for all things money, making the complex world of finance accessible and engaging. Today, we're embarking on an enlightening journey, comparing the titans of market indices, the S&P 500, NASDAQ, and Dow Jones. To navigate the financial seas, understanding these giants is not just beneficial, it's essential. So, ready for an adventure into the heart of the financial world? Stay tuned as we dive deep into these financial giants. Before we compare, let's understand what we're comparing. First up, the S&P 500 or Standard & Poor's 500. This index is a collection of 500 of the largest companies listed on U.S. stock exchanges. It's a broad representation of the U.S. stock market and the economy. The companies in the S&P 500 are from all sectors, making it diverse and balanced. It includes the likes of Apple, Microsoft, and Amazon, which are among its top holdings. Next, let's talk about the NASDAQ composite. Unlike the S&P 500, the NASDAQ is heavily weighted towards technology companies. It's a benchmark index of more than 3,000 companies listed on the NASDAQ stock exchange. This index includes tech giants such as Apple, Google, and Facebook. However, it also includes companies from other sectors like consumer services, healthcare, and finance. So while it's tech-heavy, it's not exclusively tech. Lastly, we have the Dow Jones Industrial Average, often just called the Dow. This index is the granddaddy of them all, established way back in 1896. The Dow consists of 30 blue-chip companies that are leaders in their industries. These companies are picked for their reliability and their ability to generate consistent revenue. The Dow includes companies like 3M, Coca-Cola, and Johnson & Johnson. So, to sum up, the S&P 500 is a broad representation of the U.S. stock market. The NASDAQ is tech-heavy but also includes other sectors, and the Dow is made up of 30 industry leaders. Each index offers a different perspective on the market, and they each have their strengths and weaknesses. Now that we understand what these indices are, let's see how they stack up against each other. The S&P 500, a broad representation of the market, but how does it compare? The S&P 500 is often seen as an accurate indicator of the overall health of the U.S. economy. It comprises 500 of the largest companies listed on stock exchanges in the United States, seeking to cover all sectors. It's a market capitalization weighted index, meaning the weight of each company in the index is proportionate to its market value. Now, how is the S&P 500 calculated? Well, it's not as simple as adding up the stock prices of all 500 companies. The index's value is calculated by totaling the market capitalizations of each company, and then dividing by a special divisor. This divisor is a proprietary figure developed by Standard & Poor's, adjusted as needed for stock splits, spin-offs, or similar structural changes. This calculation method ensures that the index accurately reflects the relative importance of each company. In comparison, the NASDAQ composite and the Dow Jones Industrial Average are calculated differently. The NASDAQ composite, like the S&P 500, is market capitalization weighted, but it's more concentrated in the technology sector, including more than 3,000 companies, many of them tech and biotech firms. On the other hand, the Dow Jones Industrial Average is price-weighted and comprises only 30 significant stocks traded on the New York Stock Exchange and the NASDAQ. The S&P 500, with its broad representation and sector diversity, offers a more comprehensive picture of the market than the NASDAQ or the Dow Jones. It's a reliable barometer of the U.S. stock market and, by extension, the U.S. economy. However, each of these indices serves a purpose and tells a different story about the market, and understanding these differences can help investors make informed decisions. The S&P 500 provides a wide market perspective. Now let's move on to the tech-heavy NASDAQ. NASDAQ, the home of technology and innovation, but how does it stack up? NASDAQ, often referred to as the tech titan, is an American stock exchange that's become synonymous with the technology and innovation sectors. NASDAQ stands for the National Association of Securities Dealers, Automated Quotations. Quite a mouthful, isn't it? NASDAQ is distinctive in its composition, housing the giants of the tech industry from Apple to Amazon, Google to Microsoft. So if you're keen on tech stocks, NASDAQ is your playground. It's calculated using a market capitalization weighted index, which means the larger companies have more influence on the index's performance. But how does it compare to the S&P 500 and Dow Jones? The S&P 500, as we've previously discussed, is a broad representation of the US stock market. It's more diversified with companies from various sectors, not just tech. This means that while it might not have the high-flying tech stocks' dramatic rises, it also doesn't have their dramatic falls. It provides a more balanced view of the market's overall health. On the other hand, the Dow Jones, or the Dow as it's often called, is a price-weighted index of 30 significant companies traded on the New York Stock Exchange and the NASDAQ. Unlike NASDAQ, it's not heavily tech-focused. The Dow is often seen as a barometer for the US economy. One key difference between NASDAQ and the other two indices is its heavy focus on the tech sector. This means it can be more volatile, as tech stocks often experience significant price swings. However, this also means it has the potential for higher returns, especially in a tech-driven economy. In conclusion, NASDAQ offers a concentrated dose of technology and innovation with the potential for high returns, but it also comes with higher volatility. The S&P 500 and the Dow, in contrast, offer a broader, more balanced view of the market and the economy. NASDAQ gives us a glimpse into the tech world, but what about the Dow Jones? Dow Jones, the industrial powerhouse, but how does it measure up? The Dow Jones Industrial Average is a price-weighted index that represents 30 of the largest and most influential companies in the United States. Unlike the NASDAQ, which is heavily focused on technology, or the S&P 500, which covers a broader spectrum, the Dow Jones is often seen as an indicator of the industrial sector's overall health. The Dow Jones is calculated differently from the other two indices. It's price-weighted, meaning the companies with the highest stock prices have the most influence on the index's performance. This is quite distinct from the S&P 500 and NASDAQ, which are market capitalization weighted, where the companies with the largest market value hold sway. But what does the Dow Jones represent? Well, it's considered a window into the condition of the American economy. When you hear news about the market doing well or poorly, often they're talking about the Dow. It's a quick and easy snapshot of how the largest US companies are performing. Now let's compare. While the S&P 500 offers a broader overview of the market, the Dow Jones focuses on a smaller but highly influential group of companies. On the other hand, the NASDAQ, with its tech-heavy composition, gives insight into a specific sector that has become integral to our modern lives. But remember, the Dow's price-weighted methodology means a high-priced stock can sway the index more than a lower-priced one, regardless of the company's overall size or health. This is unlike the S&P 500 and NASDAQ, where a company's market value is the deciding factor. So, is one better than the others? Not necessarily. Each index provides a unique perspective on the market, offering investors different insights. Whether you're looking at the Dow Jones, the S&P 500, or the NASDAQ, it's crucial to understand what each index represents and how it's calculated to make informed investment decisions. The Dow Jones provides a snapshot of the industrial sector, so how do they all compare? So we have our three giants, but which one stands tall? Let's summarize. The S&P 500, the gold standard of indices, offers a broad view of the US markets. It's composed of 500 of the largest companies listed on the stock exchanges. This index is diverse, covering multiple sectors, and is often considered a reliable indicator of the economy's health. However, its broad scope might dilute the impact of high-performing sectors or companies. Next in line we have NASDAQ, the tech titan. It's heavily weighted towards technology companies, making it an excellent choice for tech enthusiasts. But remember, with high rewards come high risks. As it's so tech-centric, it can be more volatile, especially during technology sector downturns. Finally, we have the Dow Jones, the industrial powerhouse. This index consists of 30 highly influential companies. It's often seen as a snapshot of America's corporate elite. However, its small size and focus on traditional industries might not reflect the overall market trends as accurately as the S&P 500 or NASDAQ. In essence, each index offers a unique perspective on the market. The S&P 500 provides a broad view. NASDAQ leans towards the tech side, and Dow Jones offers a glimpse into the industrial sector. Your choice should depend on your investment objectives, risk tolerance, and interests. Understanding these indices can help you make informed financial decisions. And that wraps up our comparison of S&P 500, NASDAQ, and Dow Jones. We've journeyed through the giants of the financial world, dissected their unique characteristics, and seen how they stack up against each other. It's clear that each has its own strengths, appealing to different investors with varied strategies. We encourage you to continue exploring and learning about finance and investing. Don't forget to subscribe to Cashflow Positive for more interesting facts on finance. If you found this content useful, hit the thumbs up button. It really helps the channel. Until next time, stay financially savvy and cash flow positive.